Okay, we're going to focus on an income set of stocks this week. In particular, the best electric utilities out east for income. Come on, let's go swimming with the sharks and I'll show you what I mean. We are diving right in with Consolidated Edison. They're green because I own shares in Consolidated Edison. Ticker ED. Their dividend yield is 3.9%. It's gold because it's greater than the Dow Jones Industrial average yield, which is 2.6 right now. But I also want to point out that this is greater than the average utility yield, which is 3.5%. So ED is definitely an above average payer. Those of you that have seen a few of these videos now may notice that I've added a new set of data, price on valid date, which means that on the 15th of February, ED was trading around 77.59. ED is a Div 0, so 17 years of increasing dividends per share. Now, I want to point out that ED has some exposure to Pacific Gas and Electric's bankruptcy filing through their alternative energy sources they sell to PG&E, so there could be some revenue ramifications depending upon how that bankruptcy plays out. Here's their long-term cash flow earnings and dividends per share trend line. Relatively smooth upward, not great, but relatively smooth. Sure would like to see that dividend a little better, but hey, it's above average, so no complaints. And here's what it looks like on the year to year. Dominion Energy, ticker E. Wow, look at that yield, 5.2%, trading on a price of 71.93. And Dominion is also a Div 0, so 17 years of increasing dividends per share and yielding 5.2%. Here's what that looks like on the long-term trend, and overall that's not a bad set of trend lines there. And here is the year-to-year change. Eversource, ticker ES, their dividend yield is 3.1, so it's above the Dow Jones Industrial average yield, but it doesn't make the utility average, which is 3.5. They're trading around $70 there at 69.3. They are also a Div 0. Here's their long-term trend. Ouch, that's not looking too good for the cash flow. Earnings are relatively smooth and upward trending, but as we noted, those dividends are nothing to write home about. NextEra Energy, ticker NEE. They're only yielding 2.8, but that's on a price of 178.17. So not too bad. And they are also a Div 0. Now, NextEra, like Consolidated Edison, has some exposure to Pacific Gas and Electric as they sell some of their renewable energies to PG&E. So again, depending on how that bankruptcy filing plays out, that could impact their revenue streams. Here's their long-term cash flow, earnings, and dividends per share. Not too bad. And here's the year-to-year. PPL used to be Pennsylvania Power and Light. PPL, wow, 5.4%. That's some pretty good, solid dividends on a $31.06 share price. Something to consider, though, they are a Div 1. You can see they had a flat year between 10 and 11. But 5.4 is nothing to shake a stick at. oh, well, this may be a consideration. Boy, that cash flow and earnings is not looking real good. Pretty flat there. But again, these are regulated industries. So those of you that spend a lot of time in the utilities, you're probably not overly surprised, but still this, it's a little bit of concern, because how can they keep pushing those dividends up if their cash flow and their earnings are, well, relatively flat? And here's the year to year. Southern Company, SO, 5.1%, and that's on a share price of 48.73, and they are a Div 0. Div 0, so 17 years of increasing dividends per share. That's actually some pretty smooth lines there compared to some of the other ones we've seen. Upward trends, relatively smooth. And here's what the year to year looks like. All right, so I want to give you all a chance to see what these folks look like stacked up against each other. So I created this little chart. Here you can see in the order of the decreasing yields. So we've got a group of 3 that are in the 5% yielding category: PPL, Dominion, and Southern. Now remember, PPL is a Div 1. Dominion and Southern were Div 0s. And then we've got 2 of them that are in the 3% group: Consolidated Edison and Eversource. And then finally NextEra at 2.8. But NextEra was also, that's 2.8% on a pretty hefty share price. But you all know that this doesn't tell the whole story. So let's compare the cash flow, earnings, and dividends per share for these 6 companies. Here we have the cash flow per share, and you can see that NextEra is outperforming everybody else, with Dominion and Consolidated Edison coming up in a distant second and third. Now when we look at earnings per share, we again see that NextEra is outperforming everybody, with Dominion and Consolidated Edison almost equal now out in as we move out into 2020, but still a distant second and third. So now when we take a look at these dividends per share, there's another story going on in our head. We have seen that NextEra Energy is consistently outperforming everybody else. And then in consistent second and third place, we have Dominion Energy and Consolidated Edison. So we've got a little different story going on now. So I'd really like to hear what all of you have to say, because I'm trying to figure out now what I want to do. Do I want to go spend the extra money for NextEra Energy and build into that, or do I stay with the lower price Dominion and build up there? I already own a bunch of Consolidated, so I want to diversify a little bit here. Please leave your comments down below. If you like this discussion and the other ones that we've been having, go ahead and hit that like, subscribe to this channel, hit the bell so you keep getting our updates. Tell your friends all about it so they can come in and learn as well. I look forward to your comments down below.